A major restructuring of the GST rate structure, probably the biggest since the indirect tax regime came into existence in 2017, is on the cards. The group of ministers on rate rationalisation has proposed a separate 35% GST slab for demerit goods like cigarettes, tobacco products and aerated drinks. Now, the cess component on tobacco products is also likely to continue. The GOM has also proposed to tweak GST on at least 148 items. They have recommended increasing the tax on high-end ready-made garments, cosmetics, watches, shoes, among other items. However, here's a caveat. These are proposals and the final decision will be taken by the GST Council when it meets on the 21st of December in Jaisalmer. Well, to discuss these proposals, we are now joined by a panel of experts who will take us through what they believe the implications and the impact could be to the GST architecture and the economy at large. Najib Shah, the former chairman of the CBEC, is with us. Also, MS Money, GST partner at Deloitte India, and Saurabh Agarwal, the tax partner at EY India. Gentlemen, appreciate you joining us on the program. Mr. Shah, let me start by asking you, we had a rate rationalization GOM, first under Sushil Modi, then under the former Chief Minister of Karnataka, S.R. Bommai, and then, of course, the GOM was reconstituted given the many changes across states. The TOR, and just one of the terms of reference, and I'm reading out from the TOR, review the current rate slab structure of the GST, including special rates, and recommend rationalization measures, including the merger of tax slabs required for a simpler rate structure in GST. Now, if what we are given to understand is taken to the GST Council when it meets on the 21st of December, we're not talking about simplification. We're not even talking about merger of tax slabs. We're in fact looking at a 5-rate GST structure. What do you make of this?
Look, we're speculating right now because the ask, if I may say, was to look at merger, which has always been one of GST's greatest criticisms, that there are too many slabs, and hence you have to compress the slabs and reduce it. And the belief was that 18 and 12 will start merging, and we'll come to a rate which will be a weighted average rate. The rate suggested at that point of time 15 to 16%. But currently, the weighted average has come down dramatically thanks to all the exemptions which have been taking place right through. So you're now at about 11%. So if you have to have a revenue neutral rate, it's going to be much more than 15, 16. 18% is a major revenue giver. So I really do not know where this 35% has come into play. Obviously, I think what they're looking at is a merger of the cess element, if at all this happens, into the existing rates, and pushing some more items into the 28% slab, which is always an outlier. I mean, we can't have had now more goods beginning to start to sin that we should bring them to 28%. So I'm really surprised with this present recommendation. I'll really be curious to see what happens on 21st.
Yes, you're right in pointing out that this is, at this point in time, not official. We will have to wait for the GST Council to meet on the 21st of December, but this is what we're given to understand are the proposals of the group of ministers who met yesterday. But, just to, once again, for the benefit of our viewers, and I'm reading out from a parliamentary response of the Finance Ministry, where they're talking about the revenue neutral rate to, just go back to the point that you were making. It says the committee headed by Dr. Arvind Subramaniam on the GST was of the view that the revenue neutral rate should be between 15 and 15.5%. The average GST rate for financial year 2023-2024 is 11.64%. But Mani, let me come back to you now, and going back again to the point that was being made. Taking the rate to 35% for sin goods like cigarettes, tobacco products, aerated drinks. And by the way, we're given to understand that this will not subsume the cess. The cess will be over and above this new rate of 35%. Mani, your first take.
Okay, so the first time I'm hearing of a rate called 35%, because all the discussions, as Mr. Najib Shah said, were on reducing the number of rates. And for the first time, we are hearing of a new rate, that's going to come. And if this rate is going to coexist with a cess rate, and the cess rate may be, instead of a compensation set, it could possibly be a health cess or some other cess, since we are talking of, sin goods. In that case, what is the point in increasing the rate and creating a new rate slab? We might as well subsume the increased amount of revenues that are foregone by whatever means into the new cess rate. Because even in the existing cesses that we have cess rates on some of the tobacco products which go as high as 204%. We have 160%.
Yes.
We have 90% on many products. So what is the point in creating a new rate category? Because the worry is that the moment we have a 35% new rate, let's say for tobacco products, what is to prevent at some point of time in future some other products being moved up there? Because at that point of time it became a necessity. So that will really distort the GST architecture in entirety.
Yes, that is a concern. But Siddharth, let's address some of the other concerns, and that has to do with complexity. Now, what we're given to understand, and of course, with all the caveats, these are proposals. This is source-based information at this point in time. The thinking is also that perhaps when it comes to things like ready-made garments, above a certain price bracket, there should be the imposition of a higher GST. So 18% if a ready-made garment is above 1,500 rupees and so on and so forth. Now, will this not add further to complexities? We've already seen this experiment in some categories with shoes and so on and so forth. But it looks like we're heading into new territory across different categories where the GST is going to be price-based.
You ask me, and when I look at the GST being charged on the basis of the prices of the goods, primarily the intent is very clear that the luxury goods should be chargeable at a higher rate of tax so that those who can afford those luxury goods are paying the higher amount of taxes into the government exchequer. Even when you look at the fact that they are continuing with the cess, one of the reasons for continuing with the cess is that the GST which is received by the Indian government has to be shared between the state and the center. Whereas as far as the cess is concerned, wherein the power is retained by the center to decide how that will be divided between the state and the center.
Right. Mr. Shah, coming back to this business of the levy of GST across different categories based on price points. So, 5% for ready-made garments under 1,500 rupees, 18% for ready-made garments between 1,500 rupees to 10,000 rupees, and 28% for everything above 10,000 rupees. I mean, what is the message that this sends out?
Never a good idea. Not a good idea at all. But having said that, it is indirect taxes trying to bring in a sense of equity by having these different rates linked with slabs. Indirect tax is never equitous. I mean, it doesn't make a difference between the prince and the pauper. And these sort of measures have always been the attempt to bring in some level of equity so that the people who can afford to pay a higher price for a product will also pay a higher GST. But this doesn't contribute to simplicity. It adds to a lot of confusion. It adds to a lot of enforcement issues, compliance issues, and never a good idea. So I don't think it's a great idea.
No, not a good idea. That's it. That is what tax experts have, of course, been opining. But Mani, let's talk about the impact and the implications. On one hand, we're talking about bringing down the GST rate across what are called Aam Aadmi products. And largely, we're given to understand that that is going to be items in the food category, for instance. But to do something like this, to bring in price-based GST and differential rates across the same product category, but in different price brackets. Now, what does that also do as far as consumption is concerned? Because let's also be clear that what we've seen at this point in time is this trend towards premiumization, and it's the premium end of the market that's actually been delivering on sales. What does this in fact do? A higher incidence of tax? What is it likely to do in terms of consumption itself?
Yeah, it is. As far as the premiumization is concerned, it may not have too much of an impact on the consumption per se, because to a very large extent, that segment may be a little price inelastic, and between 18% and a 28%, the 10% increase may not really deter consumption in that particular bracket. But the larger issue remains that when the whole premise of bringing in GST was simplicity in indirect taxes, we seem to be gradually moving away a bit. And I'm sure the policymakers have very good reasons to suggest what they are suggesting. But if we have price-based categories, let's say for apparel in the beginning, that move subsequently to durables, that subsequently moves to various other products, and that sets off a complete chain of events. Now, if we have price-based categories for some items of essential consumption, now that to some extent, in the 5% category, there I can understand that a price-based system may work well because those are truly used by the masses. They are used by the common man and Aam Aadmi, as you put it. But putting it all across and putting it in the 18% category, 28% category will only lead to a large proliferation of products of 1499, 9999, 8999, all those price points will again come up.
Well, yes, that's an interesting point that you make, that we are going to see clever pricing strategies there from companies to try and escape, so to speak, the higher GST levy. But Saurabh, let me come back now and talk to you about what Mr. Shah was saying, the 28% slab. Now, that was meant to be a slab that was meant to have only a handful of products. Over the last 5 years, since the inception of the GST, in fact longer, we've seen that 28% basket grow larger and larger. What is the concern there now, Saurabh? Because, one of the other terms of reference of the GOM is also to raise required revenue. So do you believe that we're likely to see a further enhancement and a significant enhancement of this 28% bracket?
If you look at the manner in which the government is moving on in this direction, in my view, you can see a larger list of products coming into a 28% basket. Primarily, as we see money saying that these are those consumers where the elasticity of demand is very less. So effectively, that will not impact the consumption, and the government is also very clear on the same. And if you see the declining numbers of GST collection, this is one way in which the exchequer can gain. And that is how the government is looking at it.
But Mr. Shah, do you believe that the government will actually gain, will the exchequer gain by way of, higher incidence as far as taxes are concerned? Because, the argument that we've heard, for instance, for the longest time on the cigarette category is that the higher the taxes, the higher the black marketing, the higher the smuggling, and so on and so forth. If you start to see this move of putting more and more products into what was earlier envisaged as the demerit slab, which was the 28% slab, and that becomes larger and larger, what will the impact and the implications be?
Look, there's a greater incentive for evasion, obviously, by bringing in larger categories of goods in what was a rate believed to be, when we had thought of this 28% as an outlier. The bunch of the goods are supposed to be between 18 and 12. And 18 is our major revenue giver. 78-80% of the entire GST revenue comes from the 18%. It becomes challenging for the administration, for compliance, for enforcement, because the incentive to evade will be that much more. And I'm curious. I'm really curious to know how it will all pan out on 21st, because I think 18 and 12 merger is what primarily was being contemplated, and even that was going to be very challenging, because what it meant was bringing down goods from 18 towards 15 or 16, and bringing up goods from 12 towards 15 or 16 to ensure that you continue to get the same amount of revenue as you are getting now. So it is never a good idea to bring in more and more goods in the higher bracket, and to add cess onto that is not a bright idea at all.
Mani, on this merger, now it looks very clear from what we are hearing at this point in time that there is no appetite at all for any kind of a merger of slabs. As Mr. Shah was saying, that the expectation and the hope was that 5 years on that you would be able to merge 18 and 12. But at this point in time, it looks very clear that no merger, no rationalization of the slabs is on the cards. Are you disappointed, or were you expecting this?
Absolutely. I think since the time GST started, most of us have been waiting for a 3-slab structure. And I'll just step back a bit and say that when 28% was introduced, the idea was that it will apply to sin goods. And now we are hearing talks of it being expanded. So initially, it was only the cigarette and pan masala and tobacco-related products which were covered. At some point of time, it was felt necessary to cover automobiles also in 28. And then at some stage, we were told that a dishwasher, an air conditioner, cement are all sin goods. I mean, they are in the same category. And now, if this category is going to be expanded, then effectively what we are saying is that the movement of goods to an upper slab or to a lower slab is possible anytime during the year. And that brings in a lot of uncertainty for businesses overall when they do their planning for the year. I'll just take 1 minute more and just mention that in 2 years after GST was introduced, we had a GST Council meeting where on a large number of products, the rate was brought down from 28 to 18. And now if you're saying that some of those products possibly could potentially move back to 28, it is something which is very, very business disruptive. And on GST, we have to bear in mind that any change in rates impacts the entire value chain, from the input tax credit, from the systems which need to be reconfigured, from the pricing that needs to be changed, dealer distributor margins which need to be altered. It's a complete value chain which will need a tweaking. So to that extent, if we can avoid any rate changes and allow GST to stabilize on the same rates for next few years, that I think would be great for business.
And it calls into question this entire aspect of what constitutes a luxury item. I mean, look at the graphic on our screens. The current GST rate, and I'm going to ask my producers to bring that back up across different categories, what we are seeing. Let's take shoes, for example. If a shoe costs you now, what is being proposed, if a shoe costs you more than 15,000 rupees, the proposed GST rate is 28%. The current GST rate is 18%. Going back again to ready-made garments, if a garment costs you more than 10,000 rupees, it'll be a higher GST rate above 18% all the way to 28%. So this idea of luxury and what constitutes luxury itself is in question. Mr. Shah, you want to come in on that? I mean, who decides about what price point, something constitutes as luxury for it to be in the 28% slab?
Revenue, madam, revenue, the appetite for revenue. At the end of the day, you see, we have brought in so many exemptions, like you rightly pointed out. The weighted average now is 11%. So GST revenue is certainly going to get impacted, and every exemption not only reduces revenue, it breaks the chain, the input tax credit chain. So I think these are all measures driven by an eye on how much revenue one is going to lose by the exemptions which the government perhaps is planning to bring in, or reduction in rates. And then you decide that, look, you have to have some items move to the 28% product bracket, and you bring in this price elements only because, like I mentioned earlier, equity is never the strong point of indirect taxes. To bring in some level of equity and say, look, these guys who are going to purchase a shoe of 15,000 can certainly pay 28%. That's not good taxation policy, but it makes for good revenue.
Yes, as you rightly pointed out, revenue will decide, and revenue has been deciding how we are taxed and what the rates are. But, Saurabh, coming back to you, and since we're talking about exemptions, one of the other items that the GST Council is going to take up is the issue of health insurance. And we're given to understand that broadly, what was demanded will, in fact, be given the go-ahead, and the revenue loss there is expected to be a little over 2,000 crores. Your take on insurance, and if that were to go through, what it means as far as insurance companies are concerned and the consumer.
First, I'll answer the question more from a consumer standpoint. If you see the term insurance taken by Indians, it's very, very low. Similarly, when we talk about the health insurance uptake in India, it's quite low, which means that once this particular exemption comes into, the insurance will become cheaper, and we foresee that the more consumers in India will buy the insurance, which in turn, to answer your first question now, which means that larger revenues for these insurance companies, both on the term insurance side as well as on the health insurance side.
Right. So that will be the benefit, the possible benefit as far as consumers are concerned. But again, with all the caveats that this is source-based information at this point in time, these are recommendations, these are proposals that the group of ministers has arrived at. There was a meeting that took place yesterday, and this will, of course, now be taken to the GST Council when it meets in Jaisalmer on the 21st of December. So this is going to be an important GST Council meeting to track. Najib Shah, MS Money and Saurabh Agarwal, always a pleasure. Appreciate you joining us here on the GST Centimeter to take us through what you make of these proposed changes and the likely impact. With that, it is time for us to wrap up this edition of the GST Centimeter. We're back in a moment with a lot more. Stay tuned. Here with the GST Centimeter, and we're talking about the proposed changes that the group of ministers on GST rate rationalization will take to the GST Council when it meets on the 21st of December. Now, let's bring up some of the key proposals. The tobacco and tobacco products, the current rate is GST plus the cess component. The proposed rate is likely to be 35% and the cess is likely to continue. For ready-made garments up to 1,500 rupees, the proposed rate is 5%. In the 1,500 to 10,000 rupee bracket, the GST proposed rate is 18%, and above 10,000 rupees, the proposed GST rate is 28%. When we then move to talk about some of the other categories like luxury shoes, or luxury as determined by the Revenue Department. If the price of a shoe is above 15,000 rupees, then the proposed GST rate is 28%, higher than the current GST rate of 18%. Luxury wristwatches, again, if the price of a watch is above 25,000 rupees, then the proposed GST rate is 28% versus the current GST rate of 18%. As you just heard our experts telling you, 18% is the bracket that gives the maximum amount of revenue to the government. If you look at handbags and cosmetics, the proposed GST rate is expected to be between 28% or 12 and 18% for mid-price products. Of course, what will constitute as mid-price, what will constitute as luxury, what price points will a mid-price product move to a luxury product? Those are details that are currently awaited, and of course all will be revealed hopefully on the 21st of December when the GST Council meets to take up these recommendations. Either they go through or there will be more back and forth. We'll, of course, track those developments right here on CNBC TV18. With that, it is time for us to wrap up this edition of the GST Centimeter. More news continues.